Welcome, curious minds, to another deep dive. Today, we're taking a deep plunge into a topic that might seem like it's all about the numbers.
Wow.
But trust me, there are some truly unexpected twists and insights hidden in these reports.
Definitely.
We're exploring the recent Q2 2025 earnings report from Lockheed Martin, a real titan in aerospace and defense.
That's right. And when a company as significant as Lockheed Martin reports, it's far more than just a snapshot of their bottom line, isn't it?
Right.
This complex tapestry. You've got operational performance, strategic shifts, market reactions. It's all woven together.
Mm-hmm.
So we've poured over a stack of sources, news bits, earnings analyses, market responses to really get under the hood, understand what happened, why it matters, and what it might signal for the whole defense landscape.
Okay, so our mission today, let's distill the most important nuggets from all this, make it easy for you to quickly grasp the key takeaways.
Yeah, cut through the noise.
Exactly. We'll cover everything from the surprising hits and, well, the misses to the reasons behind them and what it all means for Lockheed's future.
You'll get the full picture, financial health, segment by segment, what analysts are thinking.
By the end, you'll have that clear picture. All right, let's dive in. So let's kick things off with those initial numbers. What were the first figures that really jumped out? Did they paint a clear picture right away?
Well, the headline adjusted earnings, they certainly look strong. Lockheed Martin reported $7.29 per share,
Okay.
which actually sailed past the Zacks consensus estimate. That's the average analyst guess, basically.
Right. The benchmark.
Exactly. They expected $6.49. So Lockheed beat it by a solid 12.3%. And that figure was also up 2.5% from the same quarter last year. So, on that front, looked like a win.
And this is where it gets really interesting, right? Because the GAAP earnings, the ones including all those one-time items, special charges, they tell a radically different story.
Oh, absolutely. A radically different story. When you factor everything in, the GAAP earnings were just $1.46 per share,
Wow, $1.46 compared to what?
compared to $6.85 in the prior year quarter. And it missed analyst expectations by about 78%. Huge miss.
So what caused that massive drop?
Yeah, this sharp drop, it was mainly lower operating profit overall.
Mhm.
And then crucially, these huge pre-tax losses on several key programs. We're talking $1.6 billion.
Oof. Okay, $1.6 billion. We'll circle back to that. But first, what about revenue? Top line. Any bright spots there?
Net sales came in at $18.16 billion, which was just up a tiny bit year over year, 0.2%.
Barely moved.
Right. And it actually missed the Zacks estimate of $18.56 billion by 2.2%. So, a slight miss on revenue, but like we said, the real drama was in those GAAP earnings and those big charges.
So you've got this really mixed bag. Adjusted earnings beat, great. But a major gap miss, revenue shortfall.
Yeah.
How did the market react to all this?
Swiftly and, frankly, pretty brutally. Lockheed Martin stock, LMT, had plunged about 6 to 9% intraday right after the release. Yeah. Clearly signaled investors were deeply rattled by that gap miss and those program charges, even with the adjusted earnings beat.
Which really raises the question, doesn't it? Why did the market focus so heavily on the JAP figures and those specific losses?
Exactly. It tells you something about what investors prioritize.
Okay, let's unpack that $1.6 billion in pre-tax losses. That number really jumps out. Can you drill down into that? What specific programs took the hit?
Certainly. So the main culprits were, first, a $950 million loss on a classified aeronautics program.
Classified. Okay, so not many details there, I guess.
Right, by definition. But then there was an additional $570 million related to international helicopter programs, specifically impacting contracts for Canada and Turkey.
Ah,
And our sources also mentioned smaller items adding up, $66 million asset write-off, $103 million tax charge. But those first two were the big ones.
so with classified programs or even these international helicopter deals, what typically causes such huge losses? Is it tech problems, delays?
It can be a mix of things. Often it's unforeseen technical hurdles, maybe scope creep where the requirements change, or just significant delays pushing costs way up. For the helicopters, it suggests maybe specific contract issues or production difficulties really hurting the bottom line on those deals.
Got it. And beyond earnings, what about cash flow? Because you often hear that cash flow gives you the real story of operational health.
That's a crucial point. And here the story wasn't great either. Cash flow from operating activities was just $201 million.
Just $201 million compared to what last year?
Compared to $1.9 billion in the prior year quarter. A massive drop.
Wow.
And free cash flow, that's operating cash minus capital expenses, actually turned negative, minus $150 million.
Negative free cash flow.
Yep. A really stark contrast to the positive $1.5 billion they had a year ago. Not exactly what you want to see, unless maybe your competitor.
Huh. Right. That plunge in cash flow is really striking. What are the immediate implications of negative free cash flow for a giant like Lockheed? Does it, like, tie their hands?
Well, this cash flow weakness is more than just notable. It's a critical signal. Negative free cash means they actually had to burn cash this quarter just to fund operations.
Instead of generating it.
Exactly. And that limits their immediate financial flexibility, for new investments, paying down debt, even those share buybacks they like to do.
Did they still return cash to shareholders this quarter?
They did, interestingly. They returned $1.3 billion through dividends and buybacks. But, doing that against this challenging cash flow backdrop is notable.
And their cash position overall?
Total cash and equivalents ended at $1.29 billion, down quite a bit from $2.48 billion at the end of 2024. Long-term debt did tick down slightly, though, from about $19.6 billion to $18.5 billion.
Okay, let's dig into the segments now. Because with a company this big, it's never just one story across the board, is it?
You're absolutely right. Quite a variation. Let's start with aeronautics. Sales there were actually up 2% year over year, hit $7.42 billion.
Driven by F-35, I assume?
Primarily, yes. Higher volume from the F-35 program, which is obviously a core strength. However, this segment shockingly booked an operating loss of $98 million.
A loss in aeronautics.
Yep, a huge reversal from a $751 million operating profit a year ago. The operating margin went from positive 10.3% to negative 1.3%. This is clearly where those big classified program losses hit hardest.
Wow. An operating loss in aeronautics, even with F-35 sales up. That really says something about the scale of those other program issues, doesn't it?
It certainly does.
Yeah.
Indicates problems beyond just that one classified program, potentially.
Okay, what about missiles and fire control? How do they do?
Missiles and fire control, they had a solid performance. Quarterly sales were up 10.7% year over year to $3.43 billion.
Good growth there.
Yeah, mainly due to higher sales from tactical and strike missile programs. Operating profit was up too, 6.4% to $479 million, although the operating margin did shrink just a little bit by 50 basis points down to 14%.
50 basis points, so 0.5%. A slight squeeze on profitability there.
Exactly. Still strong, but a slight margin compression.
And the space unit, always fascinating.
Space did well. Top line improved 3.5% year over year to $3.31 billion.
What drove that?
Mostly higher sales from commercial civil space, think the Orion program, and also strategic and missile defense programs. Operating profit increased 4.6% to $362 million. And the operating margin actually expanded slightly, up 10 basis points to 10.9%. So space was definitely a positive spot this quarter.
Okay, good to see. Finally, what happened with rotary and mission systems, Sikorsky helicopters and all that? Did they struggle too?
They did. Rotary and mission systems saw a significant decline. Quarterly revenues fell 12.2% to $4 billion year over year.
Ouch, why the drop?
Attributed to lower sales from Sikorsky helicopter programs, less production volume for Seahawk programs, and also lower volume for their integrated warfare systems and sensors, or IWSS programs.
And the profit.
This segment also took an operating loss, a $172 million loss, compared to a $495 million profit in Q2 2024.
Another loss.
Yeah. Operating loss margin was 4.3%, down sharply from a 10.9% profit margin last year. This clearly shows the impact of those international helicopter program losses we talked about earlier. Hit this segment hard.
Okay, so a really mixed picture segment-wise. Losses in aero and rotary, growth in missiles and space. Looking forward now, how did Lockheed update its 2025 guidance after all this? Did this quarter change the outlook for the full year?
This is critical info for investors, setting expectations. And, interestingly, they maintain their full-year sales forecast, still expecting sales between $73.75 and $74.75 billion for 2025.
Maintain sales guidance. Okay. That seems like maybe a bit of good news amidst the bad.
Potentially. The Zacks consensus estimate is actually slightly above the midpoint of that range, around $74.3 billion. So, holding the line on sale.
Well, what about earnings per share guidance? Did that hold steady too, or?
Here's the big change. Lockheed significantly lowered its adjusted EPS guidance for 2025.
How much lower?
They now expect adjusted EPS between $21.70 and $22. That's a steep cut from their earlier range of $27 to $27.30.
Wow, that's a $5 drop at the midpoint.
Exactly. And the consensus estimate was way up at $27.21, so this new guidance is considerably below what analysts were expecting. Signals a definite hit to profitability for the full year.
That's a sharp cut. Okay, What about cash flow guidance for the full year, especially after that negative free cash flow this quarter? Did they lower that too?
Surprisingly, no. Despite Q2's weakness, they're still expecting to generate cash from operations between $8.50 and $8.70 billion for the full year.
Still projecting strong cash flow for the year.
Yeah, and free cash flow projected between $6.60 and $6.80 billion. CapEx also expected around $1.9 billion. So their full-year guidance implies they expect a significant recovery in cash generation in the second half.
That's interesting, a disconnect between the Q2 reality and the full-year forecast, something to watch. Now, one thing often mentioned as a stabilizer for defense firms is their backlog, right? Their order book. How does Lockheed's backlog look?
Still very strong. As of June 29th, the backlog stood at $166.53 billion.
Billion with a B.
Absolutely. Now, that is down slightly from the end of Q1, where it's around $173 billion, and maybe a bit below some projections. But still, $166 billion is an incredibly robust foundation for future revenue.
How does that break down by segment?
Aeronautics has the biggest slice, about $52 billion. Then missiles and fire control at $40 billion. Rotary and mission systems around $38.5 billion, and space at $35.5 billion. So yeah, that massive order book remains a key underlying strength.
Okay, we touched on the immediate market plunge, but what about broader analyst sentiment after digesting this report? Did it shift significantly? What's the consensus now?
Well, the Q2 hit definitely forced some analysts to react. We saw several downgrades or price target cuts, even from firms like Citi, Bernstein, Morgan Stanley, who'd previously been pretty bullish on defense.
Like who? Any examples?
Yeah, TD Cowen, for instance, downgraded Lockheed to hold. They cited F-35 execution risks, cutting their price target to around $480. Bernstein also trimmed its target down to $551.
So some definite cooling off from analysts, which makes sense given the news. But what's the overall picture when you look at all of them? Still positive.
Surprisingly, yes. Despite those downgrades, the overall analyst consensus, according to the sources we look at, remains buy.
Really? After that quarter?
Yep. We're seeing 14 buy ratings, 10 holds, and notably, 0 sells. And the average 12-month price target is still hovering around $521 to $523.
Which implies significant upside from where the stock fell to.
Exactly. It suggests that while the short-term pain is real and those execution concerns are valid, many analysts still see fundamental long-term value here.
So this brings up a key question. What are the big risks and challenges Lockheed faces now? And what are the strengths that keep analysts, generally positive?
Okay, on the risk side. Number one is program execution setbacks. Those failures in classified aero and the helicopter programs are paramount. Can they get those back on track?
Right.
Then there's profitability pressure, competition on F-35, cost inflation hitting margins, overruns on altered legacy programs. Those are real concerns.
And the cash flow.
The cash flow weakness, especially that negative free cash flow in Q2, that's a major point of scrutiny. Investors will be watching that closely. And finally, just the nature of the business revenue is always somewhat vulnerable to shifts in defense spending, both U.S. and international. Policy changes matter.
Okay, those are the headwinds. But what about the strengths? What are the stabilizing factors?
Absolutely. Number one is still that massive backlog, over $166 billion. That supports future revenue significantly.
Provides a cushion.
A big one. Then you have the core programs, F-35, GPS satellites, missile defense systems. These remain in high demand globally. That core strength hasn't gone away.
And the budget outlook.
Despite the guidance cut, the overall domestic budget picture still seems generally supportive for the defense sector. And like we said, while some analysts cooled off, the majority still see value, targeting that, $480 to $550 range for the stock.
So it seems like the market saw this as, yes, meaningful news, especially given Lockheed's usually low stock volatility, but maybe not fundamentally altering the long-term business case.
That seems to be the interpretation, yes. A significant setback, operational challenges highlighted, but perhaps not a fatal blow to the core thesis for many.
So wrapping